Hello, hope you guys are doing well today. My name is Chris, and in this video, I'm going to describe to you a few financial devices that I think are very important for people to understand regarding credit cards, how to use credit cards, and how to use a margin account, which basically entails the concept of using assets in a trading account as collateral to either withdraw from that account or trade other assets. And the point of this is that I want to communicate a thesis to you guys about how I believe money should not really be sitting in a checking account where it's not doing anything. All it's doing is acting as liquidity for the bank, and they're making money with your money and you're not earning a cent on it. So I'm going to explain to you one device that exists with credit cards that I think is important. That I've watched probably 12 videos about credit cards and none of them talked about this one device that I'm going to tell you about here. It's not a very complicated device, but I personally believe that banks, institutions, entities have been using this for hundreds and hundreds of years already under all of our noses, and making thousands of dollars with liquidity that they have on paper, liquidity from customers or their own liquidity, and they're using it to generate higher returns elsewhere. If you enjoy this content, let me know down below, and if you want to support me, check out the link down below that checks out my broker, Interactive Brokers. I want to tell you first about why I'm credible to tell you this information. I have had credit cards since I was 17 years old, and I've never missed a credit card payment. And right now I'm 29 years old, going on 30, and I know a bit about credit cards. And in the last 4 or 5 years, I've been studying a lot about markets, how markets work, how trading works, how trading accounts work. And most of you guys who watch my content, you know me for making videos related to Interactive Brokers. I'm going to show you in this video how I use my Interactive Brokers account to withdraw in my home currency whenever I need to pay a credit card bill. And that, in combination with using a particular device related to credit cards, which is called the grace period, which I really want to hammer home in this video and explain to you a particular thesis about why you should be paying your credit cards 3 days before the due date, approximately. Now, let's start with this, okay? First of all, if you enjoyed this content, let me know with a comment down below. Check out my other videos related to Interactive Brokers, and I'm interested in software development, all this stuff. Now, the first thing is, none of this in this video was related to financial advice. I'm not giving you advice or recommendations as to what products to trade. I'm only giving you either trades that I'm in specifically or things that I think is information that I think could actually benefit you in improving your knowledge about how markets work, improving your knowledge about how finance works in today's day and age. So I'm sure you guys, in regards to credit cards, have heard about this term called the grace period. What the grace period is, technical definition is from the date the bank issues your credit card statement until the date your statement is due. Normally, they give you about 3 weeks, something like that. But I'll tell you why that period is not that important in regards to what I'm telling you right here. What I think is more important is to understand the amount of days you have to spend money on your credit card before you actually have to pay for it. And that's actually a different number of days. It's actually about 50 days, depending on the credit card you have. So I have a credit card with Royal Bank in Canada. Now, with that particular credit card, from the moment they issue you your credit card statement until the next statement is due, that's your period of about 51 days. And in my opinion, that's what I like to call the spending period. Let's say it's from January 6th. You can buy, and the statement for January is only going to come in February, and you're going to have to pay it at the end of February. So that means that you have more than 50 days to make up that money and pay it at the end of February. Now, normally, you should not be spending more money than you actually earn, logically. But what I want to explain to you is, what do you do with the money when you're not paying your credit card? And this is why I think it's so important that you need to pay your credit card 3 days before the due date. Because in my opinion, and I think a lot of others would agree with me, is that you actually have a lot better uses for that money during the time where you're not having to pay your credit card bill. So if you only have to pay your credit card bill at the end of February for all of the things you bought in January, it means that you can invest your money elsewhere and potentially use it to do other things in the meantime. The primary investment vehicle that you would use is fixed income investing. So the simplest example would be, let's say you earn income in a particular currency, let's say it's Canadian dollars. You could go ahead and use a high interest savings account that pays you 6%, keep your money there, and then 3 days before your credit card is due, go ahead and take the money out of the savings account and pay your credit card. And what you would be doing there is every single day that passes, you're earning a return on the capital and you're essentially hedging against some inflation, and you're essentially earning a small return on that money every single day. Instead of paying your credit card early, the money is actually being used to generate you a form of a return. Now you can extrapolate this a little bit. You can do different things with the money. You don't have to invest in a high interest savings account. It could be used for so many other things. Now, the main thing I want to get across is the concept of deferral. Deferring your payment into the last possible moment. Now, we're not deferring payments because we can't afford to make the payment. We're deferring the payment because we have better things to do with the money before we have to make the payment. This is how investors should be thinking, in my opinion. And this is what nobody on YouTube talks about. Everybody's talking about the main theoretical things about how credit cards work, but they're not talking about how they're actually supposed to be used. So another reason why you would do this and why people would do this is because as you accumulate more wealth and more liquidity in your corporation or as an individual, let's say you start making more and more money, what can often happen is your capital outflows are less than your capital inflows. So you might be making more money than you're actually spending, which is obviously pretty good because it means you're making money. And people will be like, what do I do with the money? I'm making all this money. What do I do with it? Let's say your credit card bill is $3,000 a month, and let's say you're making $6,000 a month. You have an extra $3,000 every single month sitting around doing nothing. What do you do with that money? Now, if you're an avid risk taker, maybe you're going to use that money to blow it all on one crypto trade. I'm just joking. But normally people don't have that kind of crazy risk tolerance, so they're going out and taking shots with all the money they're making. So what I would say is it really depends on the person. Like for me personally, I'm quite busy. Often I'm programming and making videos. So I often have liquidity and capital that's sitting around doing nothing. So what do I do with that capital while I'm not using it, while I'm planning to deploy it? Often it's either sitting in a high interest savings account or it's invested in US bonds, and I'm using the collateral from those bonds. I'm withdrawing out of the account where the bonds are, and I'm investing that in other things like cryptocurrency stakes. So that's an example of how I would deploy capital that's not being used and kind of use it to hedge against inflation at least. And obviously the best case scenario is earn you a pretty decent return. In the case of crypto stakes, when crypto's hot, those earn pretty good returns. And this is not advice to do that. I'm not recommending you to do that. I'm just explaining to you what I do, okay? So the concept there is basically your bills that you have to pay versus the amount of capital that you have sitting on the sidelines. Oftentimes, when you start making more money, you have more capital sitting around the sidelines. It's important to develop some ideas or concepts or learn about what to do with that money sitting on the sidelines instead of just giving it to the bank and it's sitting there, and the bank is using it as liquidity to make money for themselves. Because I can guarantee you, I would bet a lot of money that they are doing that. They're using the liquidity on their books to go ahead and take shots in fixed income investments like mortgages and whatever the banks do. Like I said, I believe banks have been utilizing these concepts for hundreds and hundreds of years. Now, I will give you a personal example now of how I use my Interactive Brokers account to earn a fixed income return and also withdraw against the value of assets in the trading account to go ahead and invest elsewhere and pay my bills in Canadian dollars. And it's as follows. So the active income that is earned is in US dollars. That's the first thing. What currency are you earning your active income in? So I'm earning income in US dollars. Then I deposit the money into the Interactive Brokers account. Then from there, I have multiple choices. Because it's a margin account, I can withdraw against the value of those US dollars in another currency if I wanted to. That's one option. So if I wanted to withdraw Canadian dollars out of the account, the US dollars are acting as collateral to withdraw Canadian dollars, and that's not a problem. Another step forward with that would be buying US treasuries, and I have a video on how to buy US treasuries on Interactive Brokers and how to determine the best date for the maturity date. Check it out right there. So you would buy bonds, let's say you would earn about a 5.5% return there, and then Interactive Brokers lets you again withdraw against the values of those bonds or trade assets leveraging the value of your bond positions, which is fine. So what I do is, because I'm a little bit bearish on the Canadian dollar and I happen to have to pay bills in Canadian dollars because my corporation is incorporated in Canada and I live in Canada most of the year. So what I'll do to pay the bills in Canadian is I'll withdraw against the value of the US Treasury bills in Canadian dollars into my Canadian checking account, and then I'll go ahead and pay my credit card bill in Canadian dollars, normally a few days before the due date, because every single day that passes is a day that I could be earning a fixed income return on the money. Now, Another step of complexity here, if you want to set yourself up to earn even more returns, is the money you withdraw that are leveraged against your treasury bill positions or stock positions. It doesn't have to be treasury bills. That doesn't have to be used just to pay your bills. You can reinvest that money somewhere else. So you could use it to conduct business. You can use it to pay people to do things for you that might generate you an even more of a return. Or you could use it to invest in another fixed income asset that would be considered more risky, like cryptocurrencies or cryptocurrency stakes. So maybe you would go ahead and use those Canadian dollars and then send them over to some crypto exchange and then stake the crypto to earn like a 12% or a 20% return or even more, assuming that you hopefully trust that that crypto exchange is not going to go bankrupt or anything or take your money. Definitely do your own due diligence there. What I'm explaining to you is a concept of withdrawing against the value of your assets and then using that money to go ahead and reinvest in another asset. And then maybe somewhere down the line, that asset will allow you to act as collateral to invest in another asset, but now we're going a little too far here. That would be something like, I think that goes down the lines of like a Ponzi scheme at that point. The main concept I'm trying to get across here is using your liquidity in your Interactive Brokers account to conduct business. So let's say you withdraw against the value of your T-bills. You can use that to pay your bills. You can use it to pay your employees to do work for you, to earn your company more return, or to grow your business further. Or you can invest in other fixed income positions or other risky positions, depending on your risk tolerance, that can earn you potentially an even higher return. It's all about basically what you're willing to do and what opportunities you are currently presented with now. And that's going to be your determining factor as to how much leverage you want to take against the value of your original assets. Now, all of this might sound a bit complex for some of you guys, and some of you guys might ask, like, how do you calculate the rate of return if you have, say, one position earning you 6%, one position costing you 7%, another position earning you 12%? How do you calculate the rate of return? I actually invented a software that does that, and the code for it is currently open source. At least it was a beta version that I put open source on my repository, so you can go and view that if you want. It's free. I don't have a working desktop version of it yet because I've been quite busy, but I do plan to complete that at some point. And it works very well. It's a very simple application that you can input multiple values of positions in there, positive as well as negative rates of return. And what it is basically a calculator that blends those rates of returns together that can give you an estimate of how much you're actually going to be earning on your positions. So the main concept I want to get across here, guys, is the concept of deferral and deferring your payments until the last possible moment where you need to pay them. And this is what credit cards can do for you. When you have your everyday expenses that you need to pay anyways, in my opinion, it's better to put them on a credit card so you can defer it, so that you can wait until 3 days before the statement to have to pay it. Meanwhile, you use the capital that you're going to use to pay the bill anyways. You're using it to invest in some sort of fixed income, or if you have higher risk tolerance, using it to do something else that would be considered more higher risk. And the money that you're going to use to pay your bill is earning you a return on the side, which is helping you hedge against inflation and potentially even earning you a return and making you money. Meanwhile, when the day comes where you have to pay your statement, you just do a bit of moving funds around and you go ahead and pay your statement, and then everything is good, and then you repeat the process over and over again. And that is the main benefit of credit cards that no YouTuber talks about. It's that whole thing about deferring your payment until 3 days before the payment. The reason I say 3 days before the payment is because you need to allow at least a 1 or 2 business days for the payment to post, and some banks actually post the payment on the same day. So just consult with your bank to determine, what's that period of like when you make your payment towards your credit card, what's like the average time it takes for it to post on the account, because obviously you don't want to like have a late payment or anything. So that's it, guys. Defer your payments and use your money to earn you more money. That's basically what I'm talking about. Hope you guys enjoyed this video. Thank you very much for watching, and I'll see you in the next one. Cheers.